Like and subscribe to my channel and click the bell icon to get new video updates.
Analysis thought the hike rates were hard? Wait for the break. Central banks are unlikely to be categorical about suspending rate hikes in the coming months. It may only become apparent in hindsight that the hold button has been pressed. With good reason. Inflation is falling, albeit significantly above the target. Global growth is slowing, albeit less than recently feared. A juicy piece of data, like a strong jobs number or prices looking a little too sticky, can influence sentiment on the future path of the cost of borrowing. There will be another nudge to the upside or two, maybe even three. The pitfalls of trying to pinpoint the advent of a pause were highlighted last week when the Reserve Bank of Australia raised interest rates by a quarter point, as forecast by a majority by economists. The sting was in the accompanying statement. The words were just restrictive enough to make the predictions of an upcoming break by a month or two, and pushing the Aussie dollar higher and bonds lower. It is far too early to sound the all clear on inflation, especially given that the bank is still under fire for hinting late last year that rates might not have to rise until 2024. What is striking in the RBA commentary is the lack of a clear indication that a break was on the table. Records of RBA deliberations in late 2022 showed a suspension was among the options the board was considering. Our job is to say what we think the RBA will do, not what we think it should do, wrote Gareth Aird of the Commonwealth Bank of Australia, which now sees interest rates falling from 3.35% is raised to 3.85%. He said the policy was moving into deeply restrictive territory. The risks of a mistake multiply. By the way, a sabbatical is no guarantee for relaxation. Bank of Canada Governor Tiff Macklem declared a conditional pause last month and is now defending the middle ground against both hawks and doves. Macklem believes it may take 18 to 24 months to see the full impact of higher borrowing costs. We need to pause rate hikes before we slow the economy and inflation too much, he told a business audience. We shouldn't raise interest rates any further until inflation is back to 2%. It has been a while since a central banker has publicly fretted about the risk of inflation falling too far. The hiatus can still happen, with cuts going into year-end, but there is a slight out. Governor Ri Chang-yong warned in January that markets should not rush to declare the hiking cycle over. Malaysia announced an expected hike last month, while Indonesia delivered a dovish rate hike, a quarter-point rise, amid sentiment officials had done enough. When uncomfortable dates pour in, both will be under pressure to try again. The obvious criticism. Why did you take the risk of doing too little instead of too much? Risk management just isn't what it used to be. In his first speech as Federal Reserve Chairman ahead of the institution's annual Jackson Hole retreat in 2018, Jerome Powell spent much time praising Alan Greenspan's approach. He particularly liked the maestro's habit in the 1990s of delaying bit by bit until decisions became clearer. Then it became a question of whether and when it makes more sense to end a break than to stay put.